Welcome back to Smart Stock Sam, the channel where we dig past the headlines and find the real money moves. And today, we are diving into a stock that has been absolutely hammered, yet might just be the most exciting generational buying opportunity hiding in plain sight. We're talking about Hims & Hers Health, a company that was written off as a glorified telehealth pill shop, now quietly repositioning itself to own your entire health journey for the next 50 years. Is it still worth buying after the crash? We think the answer is a hard yes, and by the end of this video, you'll see exactly why. Let's break it down across three pillars. First, the pivot. Hims & Hers is moving away from one-off prescription sales into a sticky, recurring health ecosystem. Think of it as the Apple-ification of healthcare. Once you're inside their world, you don't leave. Second, the foundation. In 2025, they didn't just grow, they dominated, hitting $2.35 billion in revenue. Third, the opportunity. Because of short-term regulatory noise, the stock's valuation has completely disconnected from the reality of the business, creating what we call an asymmetric risk-reward setup with upside potential of 6 to 11 times your investment if they hit their 2030 targets. And there's one hidden metric buried in the subscriber data that completely changes the long-term value calculation. We'll get to it in just a moment. The old Hims & Hers model was simple: run a catchy social media ad, sell a generic prescription for hair loss or ED, and hope the customer comes back next month. That era is over. The new model is a full health ecosystem built on biomarkers, diagnostics, and artificial intelligence. Here's the stat that floored us. 70% of customers who use their testing services discovered treatable conditions they didn't even know they had. Read that again. The company isn't waiting for you to realize something is wrong. They're proactively identifying your problem before you do. That completely transforms the customer from a one-time buyer into a long-term patient inside a data-driven health loop. And that means lifetime value goes through the roof. But a great strategy is worthless without a bulletproof balance sheet. So let's look at the numbers. 2025 results were, honestly, staggering. Revenue came in at $2.35 billion, a 59% jump year over year. But here's what shuts down every skeptic in the room. They are actually profitable. We're looking at $128 million in net income, $318 million in adjusted EBITDA, and $300 million in cash from operations. This is not a money-burning startup. This is a self-sustaining machine with the capital firepower to go global. But top-line numbers only tell you half the story. The real insight is in the people behind those numbers, the subscribers. The platform now has over 2.5 million subscribers, and here's the hidden metric we teased earlier. Monthly revenue per average subscriber rose 11% to $83. That's the engagement signal. Existing users aren't just staying, they are spending more money on more personalized treatments. That is a flywheel effect kicking in. Now, there is a catch. Net new subscriber growth did slow in the second half of 2025 as the domestic GLP-1 weight loss drug Gold Rush started to cool. That slowdown is a big reason the stock has been under pressure. But while the GLP-1 story gets all the headlines, there's a hidden pillar in this business quietly becoming a titan on its own. Almost nobody is talking about the Hers segment, and that's a mistake. Hers, focused on women's health, dermatology, and mental wellness, has officially crossed a $1 billion annual recurring revenue run rate. That is a standalone billion-dollar business. And here's where it gets really interesting for valuation nerds. On a sum-of-the-parts basis, analysts estimate the Hers business alone could be worth roughly $5 billion. Now look at the company's current market cap. You're essentially getting the entire Hims business, international expansion, and all the proprietary technology for almost free. So if the business is this strong, why did the stock just take a massive hit? It all comes down to what we call the revenue mirage. The market is obsessing over headline deceleration. In 2025, they saw peak growth of 111%. The guidance for 2026, only 15 to 24% growth. To a trading algorithm, that looks like a company falling off a cliff. But look closer. There is a $65 million revenue headwind in Q1 of 2026, specifically because the company is voluntarily shifting from bulk compounding to individualized prescriptions. They are slowing down on purpose to build a more defensible, higher-margin product line. The core business is still projecting a 25 to 35% compound annual growth rate. This isn't a growth story ending. This is a growth story evolving, and the technology powering that evolution is genuinely impressive. They call it the longevity loop. It starts with molecular-level diagnostics, feeds your data through an AI personalization engine, and outputs an individualized treatment plan built specifically for you. Their stated goal is to identify mitochondrial dysfunction before clinical symptoms even appear. Think about that for a second. Catching health problems before you feel them. This moves Hims and Hers from a generic prescription company into a true health management platform. They are building a technological wall that will be incredibly hard for competitors to scale. But here's the uncomfortable truth. None of this matters if the regulatory environment blows up. And right now, that's a very real risk. This is the bear case, and you need to sit with it. The company is currently defending against active patent infringement lawsuits from Novo Nordisk over compounded weight loss medications. On top of that, there is an ongoing SEC investigation into how they disclosed those same compounded GLP-1 products. Worst case, they lose access to compounded GLP-1s entirely, and a meaningful chunk of recent growth disappears overnight. Analysts don't expect this litigation to fully resolve until 2029 or 2030. That cloud of uncertainty is real, and it is going to hang over this stock for a while. Could the lawsuits go sideways in a way nobody expects? Could the SEC take action that changes the entire business model? Those are real questions. But management has been smart about building a buffer. The vast majority of Hims and Hers revenue already comes from non-GLP-1 offerings, and to show you just how fast they can pivot, their non-GLP weight loss vertical hit a $100 million annual run rate in just 7 months. 7 months. They have the speed and the diversification to survive regulatory headwinds without crumbling. And while the domestic legal battle plays out, the company has been quietly building a global insurance policy. Their international strategy is simple. Scale outside U.S. jurisdiction to hedge against domestic regulatory risk. The numbers tell the story. Rest of world revenue grew by 825% in Q4 of 2025. Their flagship move was the acquisition of the Eucalyptus network for $1.15 billion, giving them a powerful footprint in Australia and broader international markets. They are building infrastructure that can survive even if the FDA or SEC makes life painful at home. And if they navigate all of this, the 2030 picture is genuinely transformative. Management has planted a flag in the ground. $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030. The engine driving that target isn't just customer acquisition. It's converting their existing 2.5 million subscribers from single treatment customers into full longevity management patients. If they pull that off, the margins and the predictability of this business transform completely. And when you compare those targets to today's stock price, the math becomes almost hard to believe. Right now, Hims is trading at a price-to-sales ratio of just 1.3 to 1.7 times. For context, their 5-year median is 2.7 times. The market is pricing this company for a near catastrophe, completely ignoring the fundamental fair value of what they've built. Independent analysts modeling the 2030 targets see potential returns of 6 to nearly 12 times from today's prices. You are essentially buying a hyper-growth company at a value stock multiple because of fear around the revenue mirage and the Novo Nordisk lawsuit. Wall Street itself is deeply split. Bears like BofA Securities are laser-focused on regulatory risk with a price target of $12.50. The street consensus sits at around $20.19, implying roughly 27% upside. but fundamental bull models, like the Simply Wall Street DCF analysis, put fair value at $66.19. That is a massive gap. The recent downgrades from Truist and Deutsche Bank aren't about business failure. They are about short-term anxiety. And as any seasoned investor knows, short-term anxiety is often exactly where long-term wealth is built. Before we wrap up, a quick but important note. Nothing in this video is financial advice. Smart Stock Sam is an educational channel. The projections and price targets discussed are based on publicly available analyst models and company guidance. They are not guarantees. Investing in individual stocks carries real risk, including the loss of your principal. Always do your own research and consider speaking with a licensed financial advisor before making any investment decision. Past performance and analyst targets do not guarantee future results. So here's the bottom line. Hims & Hers Health is a fundamentally strong, profitable, high-growth business that is currently being priced like a company in crisis. If you can stomach the regulatory uncertainty, if you can look past the revenue mirage of 2026, and if you believe in the long-term shift toward personalized preventative health, this is about as compelling an asymmetric setup as you will find in the market right now. The downside is a prolonged legal slog. The upside is a complete transformation of how we manage our health. The question is simple. Are you willing to be patient enough to wait until 2030 to see the payoff? If the answer is yes, Smart Stock Sam thinks Hims & Hers deserves a very serious look. Smash that like button if this breakdown was valuable, subscribe for more deep dive stock analysis, and we'll see you in the next one.